Welcome. This part of the AFSP is going to be about the life cycle of real estate, the purchase, the operation and the dwelling and the sale, and what tax clients should know from you, the return preparer. As most of you know, my name is Roman Basie. I'm president of the Center for Financial, Legal, and Tax Planning. I'm an attorney, a title insurance agent, as well as a CPA. I think it's also important to establish here I am a real estate broker as well. I have a real estate investment company that we've owned since the 90s. We've been investing in real estate for many, many years. We counsel a lot of clients with regards to their real estate investments, and most specifically, the entities that they hold their real estate in, how they report those entities for tax purposes, what the benefits are of those, and you're going to see that later in the second half of today's presentation on real estate. We will talk about corporate entities. We will talk about income and deductions and when you can deduct certain things and when your clients cannot deduct certain things. And it's good for you to have that working knowledge as a tax return preparer so that when they come in to you to help file that tax return at the end of the year, you're a little bit more knowledgeable about the inner workings of real estate and how it should be treated when it comes to taxes. So let's take a look and let's get basic. What is real estate? And we get the definition from Black's Law and from a Treasury regulation. Real estate includes the land and anything fixed, immovable, or permanently attached to it, such as buildings, walls, fixtures, improvements. And you'll notice we underlined that word. Improvements can be real estate sometimes, and sometimes they're not real estate. But roads, trees, shrubs, fences, we named roads again, sewers, structures, and utility systems can all be part of real estate as it relates to the first definition. Look at how the Treasury regulation defines tangible personal property, and they remove this from real estate. It's any tangible property except land and improvements thereto, such as buildings or other inherently permanent structures, including items which are structural components of such buildings or structures. Thus, buildings, swimming pools, paved parking areas, wharfs and docks, bridges and fences are not tangible personal property. They are real estate. And tangible personal property includes all property other than structural components, which is contained in or attached to a building. So the primary issue is segregating the costs of real estate and personal property. You want to know, as the tax return preparer, what part of this are we going to consider as real estate and what part of it are we not? You may represent a developer. You may represent someone that built an investment property. Maybe they built an apartment. Maybe they built a duplex. Maybe they built storage units. We see storage units all over the place going up these days. You need to know what parts of those are real estate for depreciation and for tax purposes. Look, we just defined fences is part of Black's Law Dictionary. So if your client comes to you and they say, well, I built a storage facility, I have 100 units, I put them on a couple acres of land that I was given by my father, then the fence that's put around that eventually becomes part of the real estate, and it's taxed like that, and it's depreciated like that. And the primary issue is cost segregation when we classify these assets. What did we pay for each one? The definition of property is also important for purposes of Section 1245 of the Internal Revenue Code and Section 1250. They're essential for determining the eligibility for a number of other code provisions. And we've defined it as well. And take a look at some of the sections and what we can relate it to. Sometimes there's investment tax credits that are related to real estate under Section 48 of the Internal Revenue Code. And you need to look at that section when you get a chance as well. And it's based on the applicable percentage of the investment in eligible property that was placed in service during the tax year. You're going to hear that term a lot when you look at real estate as a tax return preparer, or you look at any asset that your clients may have bought. It's the placed in service date that becomes important, especially when it's real estate, because what do? We build and we finish and we do things, but when we place it in service, that's when we start reporting it as a whole on our tax return. I have commercial buildings that I finish out and I lease to companies, and it may take me 3 months, 6 months, or a year to finish those spaces sometimes on the inside. Then I put the space into service, and then it becomes eligible sometimes for investment tax credits. Eligible property for some of these tax credits includes tangible personal property other than heating and air conditioning units, other tangible property that was closely integrated into the taxpayer's trade or business. For example, in fact, I'm flying out to South Carolina a day after I give this presentation today, and one of the issues I'm dealing with out there is it's a large manufacturing facility, and they've come to me and they've said, Roman, we have all these machines, we have all this equipment, and we've fixed it to the walls, and we've built it into the floor, and we've done things. What part of this are we selling? They're selling this company, and they're asking me, what part of this are we selling as it relates to the real estate, and what part of this are we selling as it relates to the operation of the business itself? And how do we segregate those two items? And really, we start here. We start with, what is the definition? Land, buildings, structural components contained in or attached to a building, or other inherently permanent structures are generally not available for all of these investment tax credits that you see, as they are truly a real estate investment, and they are limited to that. So again, we're looking at the very basics of real estate. It's a tax-driven industry. I'm on slide 3. We know that there are local taxes involved in real estate. A lot of our states, if not most, if not all, have a real estate tax. There are some states that do not have a real estate tax, and they may have a personal property tax where your client's being taxed on the personal property that they own. And you know that. If you're in the state of Missouri, you're filing a personal property tax return at the end of every year. And their real estate taxes may be very low because their personal property tax is higher. I, for one, currently reside in Illinois, is my home base. And we have real estate taxes in Illinois. Here in Florida, where I'm giving the presentation, we have real estate taxes in Florida. It's a very big driven industry based upon our real estate. Mortgage interest. You're going to learn about the deductibility of mortgage interest during your AFSP if you don't know already. It's deductible. We'll talk about it a little bit as we go later today. A primary residence is deductible. A potential secondary residence mortgage interest is deductible. What qualifies for the mortgage? Those are things that we'll talk about today as well. Points on a loan. These are charges that a bank may charge your borrower, your client, to get the loan to buy their house. How much of it is deductible? When is it deductible? Is it amortizable over a certain period of time? You're going to see in some cases, points on a loan have to be amortized. Depreciation. Can we take depreciation on our personal homes? What about investment property? Can we take depreciation on investment property? And sometimes the answer is yes. Second homes, and I just said, there's a possibility. We can take second home mortgage interest, second home tax deductions. Income. So much of our real estate investment in the country is income driven. We don't do it for appreciation purposes. We invest in real estate, and your clients invest in real estate for income purposes. Is it taxed? How is it taxed? What about when you sell or your client sells a piece of property? Is the income taxed? Can we defer the tax? I will discuss in brief some 1031 exchange information, and that's the transfer of real estate and deferring the income tax that we may have on the transfer of that real estate. And other expenses you may be able to offset when when your client sells a piece of real estate or transfers a piece of real estate. Okay, let's take a look now at slide 4, and we're looking at, and the slide is entitled Purchase. In most countries, and here in the United States, and in most states, in all states, real estate contracts must be in writing in order to be enforceable. Here in the United States, we have a law, and it's called the Statute of Frauds. It requires your clients to have a real estate contract for the sale or transfer of property in order for it to be enforceable. Other countries have other acts. I know a lot of you are dealing with foreign individuals. I get a lot of calls all year long from tax return preparers across the U.S., and a good handful of them are dealing with foreign individuals. Different countries have different rules. For example, in South Africa, there's an Alienation of Land Act, but it does specify that any agreement of the sale of immovable property, meaning real estate, must be in writing. Italy, we have a Transfer of Real Estate Act, which requires it to be notarized by a notary public, the contract itself. In different states, we have notary requirements on our deeds and on our contracts as well. The state of Florida has a notary requirement on particular leases of land. I think what's important for you to know as the tax return preparer is that if your client has sold a piece of property during the year or has bought a piece of property during the year, I would request from them the actual contract that was signed and executed. Now there's a couple of pieces of information that you can really get from them, and we'll get into some of it, but one is the real estate contract. Get a copy of the contract. Get a copy of the closing statement. We used to call it the HUD, but it's the closing statement. Get a copy of the closing statement. And why do I want you to see that? Because the contract may have said, because it's in writing, under the statute of frauds, it may have said, hey, we're going to buy this property for $100,000. I'm going to buy the house. But maybe after the contract was signed, there was some negotiation between the party. And maybe they closed on it for $95,000. Or maybe they closed on it for $105,000. Maybe there was some storage sheds or a barn or something else that got included in the contract when we went to the closing. I want to see the closing statement. Does the purchase price match up with the closing statement? Then what I want to see is what else is on there. And we'll talk about that in a little bit. What charges were on that closing statement? Did you sell a piece of property and pay commission? Did you buy a piece of property and pay commission? Did you pay real estate taxes at the closing? Did the buyer pay its real estate taxes already at the closing? You don't want to miss those at all. So it's extremely important from a tax return preparation standpoint that if a contract exists for the purchase or sale of a piece of real estate, you get a copy of it and you get a copy of the closing statement. And then finally, we want a copy of the deed. The deed is the proof that the real estate was transferred. Most states deal with deeds of trusts, regular deeds, warranty deeds, quitclaim deeds. Was it recorded? Is there a stamp up in the corner from the recorder's office in your particular county and in the state in which the property is? Was it recorded? Is it on notice? These are just little ways you can help your clients. The contract must identify the parties. That's the first step of it. The full name of the parties must be on the contract. In a sales contract, we know there's a seller and there's a buyer. There's sometimes a real estate person involved as well, and their name may be on it as well. It must identify the property. Now you'll see I have bullet point 2 and 3, address and legal description. The address is enough. It just has to reasonably describe the property within the contract itself. On the deed, we have the full legal description, and we typically do not put those on the contract. And again, what's important for you to know is, did they buy the property they said they were going to buy? Did they buy the property for the price they said they were going to buy it on the contract? And whose name is the deed in? Did they deed it if it's a home? Did they deed it to themselves? Are you dealing with a couple that's married filing jointly? Is the deed in both names? Or did they put the property into a trust? Did they put the property into a company? I really don't care what the contract says. The deed has to match the tax return. That's the legal owner of the property. We do a lot of estate planning. And clients will come to me and they'll say, Roman, I did a trust. I need to do a tax return for my trust. You know what one of the first things I ask for is? I want to see the deed where they put the property into the trust. I want to see the financial statements where they put their investments. They actually transferred them into the trust. I want to see a bill of sale where they said, I have a trust, Roman, and I took all of my personal property and I did a bill of sale to my trust. I want to see the real ownership. It's as if you were buying a car. Would you buy a car and not look at the title? Then don't let your client report property to the IRS if you haven't looked at the title. Make sure it matches. If you said, well, they put it into ABC Inc. They didn't put it in their name. It was a duplex they bought, and they put it into ABC Inc. You need to do a tax return for ABC Inc. You should not put that on their personal tax return. And we do see that often. And let's make a little side note on this as well. So many of you deal with other properties that your clients may have, and they may have them in what we call a limited liability company or a partnership. And you do have to be careful there because they may file that as a disregarded entity and put that information on their personal tax return. In that case, it's okay. The deed is going to have one name, let's say ABC LLC, but you're filing that with the personal tax return of the owners. And that's okay if they're what we call a disregarded entity. And you've heard that term before. You'll learn more about it throughout your program today and the rest of the program as well. So keep that in mind. Identify the purchase price. Again, we just talked about this. The purchase price should be on the contract, and the purchase price should be on the HUD. In some cases, the purchase price is also on the deed, although typically my deeds will say, look, for good and valuable consideration for the price of $10, I've transferred the real estate to so-and-so. So it does depend on what the deed does say. It must be signed. Make sure there's signatures on there. It must have a legal purpose. The parties must be competent, and they must be eligible to enter into a contract. You may think, well, Roman, a minor signed this. Can I report the sale of this real estate or the purchase of this real estate because I had a minor, there was a person at the age of 17 when they signed the contract, and they were not emancipated from their parents. It's still a competent signature. The minor can void the contract later if they want, but you can still report it at that time. So think about things of that nature as well when you're looking at the contract itself. Was there a mortgage? Is there a mortgage on the property? And you may ask me, well, what's the definition of a mortgage? Did they borrow money for the property? You may get a copy of the mortgage with the closing statement. Was there earnest money put down? What if they gave the seller directly $1,000 of earnest money, and you're looking at some type of a contract that shows, well, they're telling me, Roman, they bought it for $99,000, but they gave the seller $1,000 of earnest money directly prior to the closing. That's part of the purchase price, and that gets reported on the tax return. Taxes are a very important part of the tax return. It's very tricky. You need to get a copy of every HUD whenever you're filing a tax return and it relates to the purchase or sale of real estate, because in most states, we pay real estate taxes in arrears. I'm going to use an example. In Illinois, we will pay taxes in the summer, and they are for the previous year. So if I pay my tax bill in July, that covered me for the previous year from January to December. So at closing, if I sell the property, I'm the seller. I've already paid for the taxes for the previous year. I still owe 6 months of taxes. The buyer is going to pay my taxes the next year. That's called taxes in arrears. So at the closing in the state of Illinois, I give the buyer a credit on the tax bill for 6 months. It's important for you to know why. Because if your taxpayer comes back to you next year and says, oh, I was supposed to pay $10,000 in taxes, but I paid $15,000 because I had to pay an extra $5,000. I had to pay the tax bill for when the seller owned it half the year. Those taxes are not deductible by your buyer because they do not include the $5,000 that they got from the seller at the closing. So you need to see the HUD. Now, keep this in mind too. The seller, most specifically the seller. So the seller comes to you a year later and says, you know what? I didn't have taxes on that property. I sold it this summer. I never had to pay taxes. Wrong. We just said The seller gave the buyer a credit, and we're using $5,000 as an example. The seller gave the buyer a $5,000 credit at closing for the real estate taxes. Those taxes were paid. They were paid a year early, too. Think about it. It was from January to June that seller owed taxes. Gave him a credit on the closing statement. But those taxes would not have been due until the following year. But the seller can report those in the year of the closing. Hope I'm making sense. That's the beauty of making sure you guys see the HUD. You see the HUD, you see the contract. Improvements and fixtures go along with the purchase. There's a little point to make here that I like to use a lot. When I buy a piece of property, I segregate the cost. And I say, I may buy the property for $100,000, but I may report the sale at $75,000 for the property and $25,000 for the personal property. I'm doing that for tax purposes. It's a quicker depreciation schedule, as most of you know. If I segregate $75,000 to the real estate, I have a certain depreciation table. But if I segregate $25,000 to equipment, I can write that off a lot quicker. And then I can also petition my local tax assessor and say, hey, look, I didn't pay $100,000 for the property. I only paid $75,000 for the property. And there's $25,000 of personal property on there. So it's improvements in fixtures and things of that I'm looking at the same time as I am in the purchase. Okay, let's move on. Let's take a look at slide number 5. And we're talking about borrowing on margin, otherwise known as a mortgage. A mortgage is used by the purchaser of real estate to essentially what? Raise funds to buy the real estate. Some people may tell you, well, I bought the real estate, I got a mortgage for $100,000 and I bought the property for $100,000. That's my basis in the property. But even looking at the last slide and the bullet point that we just had on the last slide, the mortgage doesn't necessarily tell us what the basis in the property is because there may be improvements to the property. Also, I get, and I'm sure you do too, probably 99% of my clients think that, oh, well, I didn't really make that much money on my property because I had to pay off my mortgage, and my mortgage, or I'm going to be able to expense my mortgage on my tax return. And as you know, as a federal tax return preparer, the payment of the mortgage itself is not tax deductible to the client. And when they're looking at what they're going to have to pay in taxes, the mortgage itself is not tax deductible, and you know that. You know that the interest is deductible and the points are potentially deductible, but not the mortgage itself. And we make a note on this slide and we say to you, look, generally a mortgage is limited to 28% of the income of a person, but that all is so fluctuating, as we all know, and we all know that rates and things of that nature change, so these limitations are very, very vague. But limits on rental property, and I gave an example during the ethics section of the AFSP this year where we see limits on properties and on mortgages that are given to companies and to individuals based on financial ratios. And it's important for you, the tax preparer, to know that if you have an issue with a client that says, well, I can't present my tax return this way because it's going to impact my financial ratio that I'm providing to the bank, please know that that's the type of stuff that needs to be looked at from a tax perspective to say, what can be changed on the tax return? Maybe it's a C corporation you're working on and there's a balance sheet that you're reporting to the IRS and the taxpayer is saying, but I'm not going to meet my working capital requirement, Roman. I'm not going to meet my net worth requirement because of the way we're presenting it on the balance sheet, because there's a limitation on me. So those are the things that are need to be known in that sense. Okay, let's switch gears a little bit now and talk about what is deductible. A very important concept for you as you go through your filing season and as you prepare. I'm on slide 6. Most expenses at the closing on the purchase or refinancing of a home are added to the cost of the new home. There are a few exceptions. Now keep in mind that statement. So they're added to the cost. So most things you pay at closing. So if you paid $100,000 for the property, most of all your expenses that you see on that closing statement, you're going to add that to the cost of the real estate for your client. But exceptions are interest paid at the time of purchase. The charge at closing is normally done for interest up to the date of the payment. So in other words, you close on a property on January 1st. The first payment is not due until January 30th. The bank on the closing statement is going to charge interest to your client for 30 days, and they're going to make them pay that at the closing. That's expensable. Even though it may be a closing item statement, it's an expensable amount. It's still home interest, and it's potentially deductible if they itemize, right? If they're itemizing. Real estate taxes charged to your client are deductible. Again, most of these relate to if they're itemizing. Points, which are sometimes called origination fees and expressed as a percentage of the amount borrowed. On a refinance, they need to be amortized over the life of the loan or 84 months, which is 7 years, whichever is less, unless the points were used to improve the main home. So, if it's a refi of a loan and there were points paid, you have to pay particular attention to that section. Did they refinance it to improve the home? Or did they refinance it to take money out to go buy jet skis? Then you have different amortization periods. Private mortgage insurance costs are expensable, but if they're prepaid only to the amount allocable to this year based on an 84-month amortization. So essentially, PMI, what we call private mortgage insurance, it's only, you have to still take that amount and say, well, maybe you paid $1,000 in PMI, and you actually have to spread that out over 84 months, and you can only take what was deductible for that year based on an 84-month amortization table. Title fees, real estate commissions, appraisal costs, home inspections, documentary stamps, credit reports. You should be seeing all of these on a HUD, and if you have a chance, grab a HUD while we're talking about all of this, or a closing statement. Costs of an abstract, transfer taxes, flood certificates, attorney's fees. Those are not deductible, but they are added to the cost of the property. So now you're saying, oh, well, I bought the property for $100,000. I paid $500 to an attorney to look at the title work. I paid $40. They charged me for a credit report. I had to have an abstract done or a survey done. I paid transfer taxes. You know, we have a P-tax form that we fill out in the state of Illinois. I had to pay a home inspector $500 to go in and inspect the home prior to me buying it. That's not a deductible expense on a tax return, but it's added to their basis in the home. You make sure you add that to their basis. That becomes very important down the road. Or an investment property, which is even more important. As we know, and I'll go over that section here in a little bit, there's an exemption from gain from the sale of a personal residence. We don't have that exception from gain from the sale of an investment property. So that's when you have to know, hey, you paid $100,000 for the property, but you paid a $500 inspection fee. You paid an attorney. You paid for a survey. You paid a real estate commission to a buyer's agent or something. You paid these other things. We're going to add that to the $100,000. Mortgage interest, refinancing, property taxes, and mortgage insurance are all considered to be under the potential deductions, credits, things of that nature.